Yep, the cost of living crisis has been cruel to just about everyone but the banks. The CBA yesterday posting record half-year profits.
Cash net profit was also $5.2 billion, up 9%.
The rest of the Big Four expected to follow suit. For struggling households, it's hard to swallow. But here's the really maddening bit. The same interest rate hikes crippling hundreds of thousands of Aussies are what's actually driving these fat profits.
Driven by strong net interest income.
Let me explain with the help of a nifty graphic. When the Reserve Bank raises interest rates, it increases the cost of borrowing money. Naturally, the banks pass that increased cost straight onto borrowers. But banks are borrowers too. They borrow from customers with savings, term deposits, etc. In other words, rate hikes should benefit savers and hurt borrowers in roughly equal measure. But the ACCC has found that banks have a nasty habit of going slower, lower, or conditional when it comes to sharing the spoils with savers.
The banks are trying to make a profit at the end of the day, and the way they do it is charging interest on borrowers a little bit more than savers. So this has been an issue that's been going on for about 5 years, but the gap is actually widening.
When rates go up, they're passed on immediately to mortgage holders, and there's often a lag for some savings accounts. I think there's a role for the regulator to get to the bottom of that.
In the meantime, the gap between the interest banks charge and the interest they pay out, that is all profit. Now, it might look like straight-up greed, but there are good reasons behind the bank's behaviour. With rates rising and the mortgage cliff fast approaching, banks want to build up a buffer as protection against a potential wave of loan defaults.
Banks are partly lifting their profits because they know the economy is about to slow.
I know it's hard for people to accept when they're suffering, but the country is better off from having strong, resilient, effective banks who can provide the financial services that we need.
But all the talk of battening down the hatches might be easier to swallow if CBA wasn't jacking up shareholder dividends by 20%.
A dividend of $2.10, fully franked.
Moral of the story, if you really want a return on investment, maybe you just have to buy a bit of the bank.
Every Australian effectively holds shares in one of the Big Four via their super funds. So we criticise the banks, they hand out dividends, which comes back and supplements our pensions. It may not be a virtuous circle, but sadly that's the situation we've got.
Bank really has become a four-letter word, hasn't it? I mean, it's just, it's infuriating to see them post these huge profits. And I get it. I know it's a mechanism to bring down inflation, but try telling that to the people who can't find the extra couple of $1,000s a month to actually keep a roof over their heads. Like, this is really, really hurting people.
And it's hard to say, well, it's okay because I super invest in it, so I'll be the beneficiary of this in 30 years'
20
time.
or 30 years' time, yeah.
It's a hard thing to do.
I heard the CEO of Commonwealth Bank this morning on Radio National being interviewed, and he was talking about the fact that banks, by legislation, by law, have to keep a certain amount of money in the bank so we don't get the banks falling over like they did in America during the financial crisis. But I don't think that makes it any easier if you're struggling with inflation, with energy prices. And I wonder if there's a way that the government can step in or the banks can do something to help the people who this is going to hit, because they're often the people with the least amount of power to do something about it.
So the ACCC funds.